Welcome back. Today, the Philly Fed Index fell back into negative territory. This is actually quite troubling. We're going to take a look at a chart in just a moment and show you why. The Philly Fed Index is a regional Federal Reserve Bank index measuring the change in business outlook, specifically in the manufacturing sector in the Philadelphia region. Again, it fell into negative territory, negative 13.5 reported this month. Now, here's a current report. The general activity, negative 13.5 on the left-hand side. That was what was reported, but there are subsectors of this report, including inventories, unfilled orders, work hours, shipments, new orders, employment, prices paid, delivery time, and prices received. In addition to the general activity, we're also going to focus in on prices paid and prices received. I believe, this is just a guess, but I believe these are really outstanding from the rest in the sense that they tend to be more volatile as a result of their connection to inflationary pressures. The prices paid is up 25.7. The prices received is up to a level of 14.8. But overall, the negative activity, it was reported the general activity of negative 13.5. Now, here's where we look at what we look like year over year. General activity up 85%. Now, it doesn't mean that manufacturing has increased up 85%. It's just that's the year over year change in terms of the index. The index is based on a level of zero, meaning neutral. If it's above zero, it's good. If it's below zero, it's bad. So the fact that it's up 85%, it can go from 1 to 1.85. So don't pay attention so much to the percentages. It's more just to show you, how much they've changed. Inventories overall are down the most, along with work hours. Prices paid is down moderately, as well as prices received. The takeaway from this is nearly all measures of the Philly Fed Index are in negative territory on a year-over-year basis. So this September to last September, it shows a decline. Now, this goes back to 2007 through 11. We like to take a look at with these economic numbers in terms of their historical perspective as well, to try to gain some insight what these numbers look like in the past. We know during very strong economic period of time, 2007, the Philly Fed Index was quite strong. This is 2007 going to 2008. Now, the brown dotted line in particular, that's prices paid. The purple dotted line is prices received. Now, it appears, again, this is just a guess, but it appears that these numbers were positive, and to a great extent, when the rest of the index was negative, due to the fact that we had a very inflationary period of time. Now, if we were to logic through this, we'd say, okay, well, the prices are up. The prices that manufacturers pay, the prices that manufacturers receive, from the customers, those are all up. The same way right now we see because of strong oil prices, remember our last inflationary report, including energy, inflation is certainly back on the rise. Well, I think that this report shows us the same thing, that the inflation is causing these prices paid, prices received to go up. But if you take a look at work hours, that's that yellow line, below zero, moderately below zero. Inventories, so the downside, the overall general activities is dotted black line. And take a look, we were just negative around 20, January of '08, and we went down to a level of negative 40. When we see these negative 30, 40 levels, those are significant. And notice the prices paid, prices received, they are very strong until the financial crash, and then we saw them dive deeply into the negative territory. Then we had a recovery, prices paid, prices received. They were the most outstanding as inflation returned back to the manufacturing sector, so to speak. So I think the prices paid, prices received, it's very interesting to see how this deviates from the rest of the manufacturing sector because it reflects the current rates of inflation. Again, my opinion. But notice when there's a divergence, that's when you see a lot of trouble, when the prices are up and the rest of the index is down. Well, take a look, fast forward to where we are now. The brown dotted line, that's prices paid. The purple dotted line, that's prices received. Those are levels around positive 20. But look at the rest of the index. The general activity, that's that black dotted line, it's kind of hiding over here. That's negative 13.5. The yellow line, that's unfilled orders. The white line, that's new orders. So we see orders are down. What's the only real strong part about this? The prices. Prices paid, prices received. Look where the prices paid, prices received, those levels were going back to 22, even 2021. They were much higher. So we see as inflation has worked in, that's inflated the levels. What's interesting though is there's actually very little divergence. Even though the prices paid, prices received, those levels are higher, they're all basically kind of bad. Zero, a little below zero, maybe a little bit above zero. That's not what we saw in '08. The prices are actually lower than they were in '08. Surprising considering the inflation. It really shows us that there's a stagnant environment within manufacturing. And again, there are two levels of two barometers of manufacturing that we talk about here. There's more, and we want to add over time more to this as well. But there's the Empire State Manufacturing Index in New York, the Philly Fed Manufacturing Index in Philadelphia. The past month, the Empire, the New York number was bad. Last month, the Philly Fed was good. Now the Philly Fed is bad. That's not good. This is a 100-month correlation, let's say about 7 or 8 years, going back, correlating each of these subsectors of manufacturing to the S&P 500. What represents the strongest correlation? Prices paid around 60%, prices received even higher that, maybe about 65%. The general activity, it's actually a 0% correlation. When you have a zero correlation, it means there's no connection. Stocks may go up, this may stay flat, or vice versa, or any combination. There's no connection. But when we have a 60, 65, 70% correlation, that's pretty strong. When one index goes up one by 1 point, the other index most of the time also goes up. So that's a pretty strong connection. And the S&P 500, it's been strong, maybe reflecting also this inflation we're seeing. This is prices received, the red line. This is the S&P 500 in blue. Now we can see here, actually, pretty strong correlation when both lines go up together. But lately, we've seen a divergence. Stocks are higher, not today, but what we do is we lock in the prices of the S&P 500 based on the report. Now, this report is as of August 1st. So the blue line is what the S&P 500 looked like August 1st. We like to, give it an apples to apples comparison. Otherwise, it wouldn't be fair, to talk about a report that's delayed by a month and stocks now. So, but just to show you the connection between the two, manufacturing, even the inflationary part of manufacturing, prices received, it's fallen apart. Prices paid in the red line, S&P 500 in blue, same situation. We do see prices paid coming back, but still well down from their highs. Notice the S&P 500 was on 4,400 when prices paid was at 80. Well, the S&P is still in the 43s. Prices paid much less. That's prices received as well. So with that said, we have a lot coming up on the economic calendar, and we should also keep this in mind with what the Federal Reserve said yesterday, that they're concerned about inflation. They see the jobs market as soft, but not concerning. I'm paraphrasing. But when we see these numbers, we always try to take into consider what these numbers mean in terms of the big picture. The Federal Reserve is holding pat on raising interest rates as of yesterday. The Fed funds futures say most likely they're not going to raise rates in the next meeting or two. Most likely that's going to take place in January. Will they cut? Very small chance they're going to cut now or anytime in the near future. But that will change. What will change? On the growth side, meaning manufacturing, GDP, jobs, we need to see those numbers stay strong or improve. If they start to weaken or continue to weaken the way today, they've weakened, well, the Federal Reserve is going to pull back a little bit from the idea about raising interest rates, maybe just a small amount. But also on the other side, we want to see inflation come down. And that will also lead the Federal Reserve to cut interest rates. But if we continue to see weak growth numbers and a combination of strong inflationary numbers based on history, it seems like the Federal Reserve is leaning more towards, the stance of raising interest rates eventually because inflation, CPI, PPI, PCE, that is the primary barometer that they're watching. The other numbers are watching as well, but if history is any judge, the inflation numbers, they put a lot more weight on those. So we'll be sure to update you along the way with any significant changes as well. We hope this has been helpful. We look forward to seeing you back soon.